So as we head toward another results season, is the direction of the market really nothing more than a coin toss? Here with insights, Sam Stovall, Chief Investment Strategist at CFRA Research. Good to see you, Sam. Obviously, markets have had a lot to contend with over the past few months. So give us your gauge then. Is this a coin toss for the markets right now?
Well, I don't really think it's a coin toss. I think in many ways you could look to history for some sort of guidance. We are now in the third best quarter of the 16-quarter presidential cycle. And the last two that we were in, which each were both up by 7% or more, were numbers 1 and 2. What we also find is that in the second quarter of calendar years, heading back to 1990, all sizes, styles, and sectors were in positive territory within the S&P 500. And then lastly, April is the best month of the year. So you could basically say that history is telling us that we at least have one more good month to go in this rally.
Are you surprised at how well the S&P 500 has done despite some of the upheaval we've seen?
Yes, I am, because both of those fourth quarter of last year, first quarter of this year, up 7% plus, was certainly better than the historic average. And also, when you look at the fact that we're now entering into an earnings recession, we saw that earnings were down by about 4% in the fourth quarter of 2022, expected to be down 6.5% in the first quarter of 23, which is soon to be reported. And then also taking a look at the second quarter, which is expected to be off by 6%, it just implies that we are moving ever closer to a recession.
So then what do you think the bulls and the bears are honing in on at the moment?
I think the real question is, how deep will the recession be? And I think one of the main factors will be, how long does the Fed continue to raise rates? Right now, the street is expecting one more rate hike by 25 basis points in May. Our belief, however, is that they'll raise rates twice, May and June, and they'll wait until 2024 before cutting interest rates. So maybe the enthusiasm will be toned down a bit as we move forward into the challenging May through October period. But I still believe that 12 months from now, share prices will be higher.
And of course, it seems like an eternity. We have to wait until the FOMC meeting in May at this point. And add to that, of course, we're kicking off this quarter with this surprise output cut from OPEC Plus. How does that perhaps shift things for you?
Well, it doesn't really shift it. It actually sort of confirms that we're likely to see 2 25 basis point hikes. Prior to that, I was sort of wondering, well, maybe we're getting it wrong. Maybe we will only have one more rate hike. But with oil prices likely to be moving higher, our expectation is that we'll see about $85 per barrel by the end of this year. That continues to put upward pressure, or at least stabilizing the headline as well as the core numbers. So inflation will continue to be a thorn in the Fed's side. And I think that they're going to make sure by maintaining higher rates for longer that they can be able to put a stranglehold on inflation.
And as we know, the US dollar and oil have an inverse relationship. We saw as oil was rising, the dollar index started to come down. It does make imports and other sort of dollar sensitive purchases more expensive. How do you think that tightening also factors in then? Is this perhaps doing a bit of the work for the Fed?
Well, interesting point. You were asking about the stock market itself and a coin toss. You could say, well, it could be a coin toss in terms of what's going to happen with inflation because of higher energy prices, because not only does higher energy prices cause a pickup in inflation, but it also creates demand destruction. So as interest rates move higher, as oil prices move higher, we find that companies, consumers will likely cut back on their energy usage. So that could end up making this spike in oil prices be sort of a fleeting situation. So I would tend to say that while the longer term direction for equities is higher, I think that oil prices are probably going to be tracing out a more jagged pattern.
So then, Sam, where do you see the opportunities going into Q2?
Well, going into Q2, I published an article this morning looking at those groups that tend to be outperformers. So such areas as auto parts and equipment, a company like Borg Warner, we have a strong buy recommendation on. Consumer finance, American Express, also a strong buy. Even prior to hearing the news on oil prices, EOG Resources, because oil and gas exploration and production have done well. These are sub-industries within the S&P that have done very well over the last 20 some odd years.
Certainly be paying attention to those. Always great to have you on. Sam Stovall there, Chief Investment Strategist at CFRA Research. Thank you for your time.